Hi, I'm Steve Van Metre and welcome to your Monday night premiere. I want to jump right in and talk about agricultural commodities because they're not being priced into what the weather conditions are. And you say, well, what do you mean they're not being priced in? There's major flooding going through the growing region. How's that not being priced in? Because people that trade this stuff, some big, large money traders, buyers and both sellers, they wait for the official government reports to come out. Now, the challenge with that is places underwater. So how do you know what's good and what's bad? Well, we're going to look at that, and I'm going to show you some websites to show you what's coming in terms of weather, and it's not pretty, and none is being priced in. So let's get the disclosures out of the way real quick. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video is prepared by Steven Van Metre, own personal capacity. The opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's start by identifying what the problem is, and it's called lots and lots of water. So let me switch over to the browser view here. And this is an article written by endoftheamericandream.com. Catastrophic flooding in the Midwest could last for months, and that is going to mean a dramatic drop in U.S. food production. That is absolutely correct. Now let's go down. Let's kind of look at some of these headlines that the author puts in here. In fact, we'll give him credit. It's Michael Snyder. So let's say what he's tagged here, some articles. Here's one from Bloomberg. At least 91% of the upper Midwest and Great Plains is snow covered to an average depth of 10.7 inches. That is a lot of snow that is not yet melted yet. So let's go down here. Here's a very interesting a comment by the U.S. Department of Agriculture from their data. As of December 1st, producers in states with flooding, including South Dakota, Nebraska, Kansas, Minnesota, Iowa, Missouri, Wisconsin, Illinois, had 6.75 billion bushels of corn, soybeans, and wheat stored on their farms. Now, this is important. These were in storage. This was overproduction. 38% of the total U.S. supplies available at the time. So as of December, what you want to look at is more than 1/3 of all stored crops that everyone's making a big deal of oversupply is sitting right in the middle of this flooded region. Let's go back and see what else is got on here. In Fremont County, farmers estimate about 390,000 bushels of stored soybeans and about 1.2 million bushels of stored corn are underwater. And Jorgensen said that more of last year's grain was being swallowed up Tuesday as the Missouri River crests. That's interesting. At local cash prices for corn and soybean, that's about 7.3 million farmers may be unable to replace, and that's just one county. So, you look at what's going on here, and you can go on and read this article if you want, and you'll find that there's lots of stuff going on. Now, what does this mean going forward? Well, there is more adverse weather. According to NOAA, the National Organization of something that tracks weather. I don't remember the acronyms. But anyways, we're on their website. Their spring outlook says there's more flooding coming. There's going to be more water all through the growing regions here. You've got spring wheat up here. You got corn and soybeans in here. And now, granted, you can forget the minor, the yellow. That's not the issue. It's the purple and red that are really where the problems are at. And this is not good, because they've already got rain and snow in the upper Mississippi and Red River 200% above normal. There is just too much water. And when you start digging deep into how this works, so let's say you've got a big silo full of corn, soybeans, or whatever, and 1 inch at the bottom gets water. You know what happens? According to the U.S. Department of Agricultural rules, the entire bin needs to be destroyed. Entire bin, gone. And what's happening in these floodwaters, these bins are being split open. And there's water everywhere, snow that is not yet melted, and ice that's still flowing down the rivers causing problems. And they're going to get more rain. And that's what happens in these 11-year cycles is you get flooding, crop damage, and other issues. Because if they're going to get more rain and they're already underwater to begin with, how are they going to plant? They're not going to be able to plant at all. So that's a problem. They may be doing some late planting, but they're certainly not going to plant as they normally did. So we're going to watch all of this crop that is in storage as eventually the waters recede, and people can come in and say, yes, you can keep that. No, that has to go. Not to mention, homes just in general, all the storage places for farm equipment damage. There's articles talking about how farm animals are just washed away. Baby calves and just pigs just gone. Livestock crushed under ice. These things just don't get replaced overnight. So that is a big catalyst for the agricultural commodity sector, and it's pricing zero of it in. None. People just look and say, oh, it's planting season. We'll short the sector because there's too much supply. Well, the supply is going to be significantly reduced. The other challenge is getting any of that supply to market right now is not possible. Roads are out, bridges are out, and there's just water everywhere. So I think that's pretty interesting. Now let's shift over some gears to the broad market, because again, we do this update in 15 minutes. So let's switch over. Now this is an article on Zero Hedge that's talking about selling in the quant CTA model. So I want to show you here that they're saying that according to Russell 2000, CTAs are currently 50% long and will sell and flip short under 1536 to get to minus 100% short. So what that means is the Russell 2000 today needed to close below 1536 in order for these computer programs to continue selling. So let's take a look at what's going on with the Russell 2000, and there it is, and it closed at 1512. So what does that tell us tomorrow? There should be more selling coming. Let's continue on with this article and see what else it's got. The S&P 500, these quant models are 100% long. They'll sell under 2777 to get down to 50% long and under 2636. Now that's not a problem for tomorrow, because as of right now, it's at 2798. So S&P 500 affecting needs to drop a little over 20 points to get some selling by these models. The NASDAQ 100, 100% long. This has got a lot more to go. Selling under 7048. Let's go to the NASDAQ. And, oops, I'm flipping screens around here. So if you missed the S&P, we're sitting here at 2798. I may have not done that. So it needs to drop 20 points. The NASDAQ 7048. It's got, or was it 7048? Let me look back. Yep, 7048. It's got to go below its 200-day moving average. But tech stocks do tend to move quite a bit. So this has got a ways to go. Let's go back and see what else it has to say. 10-year Treasury. Currently 100% long. That's not going to change because the bond market went down. Let's take a look at oil, because as you know, I think oil is going to retest its bottom again. It's currently 13% short with more buying over 59.61. So let's go and look at where crude oil closed today. Crude oil. So it closed at 58.91. So there would be no trigger there. Let's switch back. This is actually quite difficult to do. I'm somewhat impressed that I'm keeping up with it. So more buying over 59.60. That didn't happen. To flip long, max long, no. Selling under 57.40 to get to minus 30. So where did we leave? We're at 58.91. So that could happen tomorrow. More selling under 57.39. So not much of a move to get to minus 46. And they go full short under 44. And let's flip back to the chart. So under 44. So can you imagine if we see a retest of this double bottom at 42, at 44, these computer models are going to do more selling to the extent is they're going to sell from, let's see, there it is, from minus 46 to minus 100. So they're going to be selling quite a bit more there. And all that does is bring some more validation that this is not a bottom in the oil market, that if it sells down, and these computer models sell at 44, yikes, it is going below 42. And that actually makes a whole heck of a lot of sense. So let's take a look at the broad market. The S&P 500 closed right in this long trending resistance channel. In fact, I better double check and make sure, yep, we are on the right screen. For a moment there, I just assumed that we weren't on the right screen. Seems that happens a lot more than I'd like it to happen. So here's this long 2-year long resistance channel. Stocks peaked over that over the last week. Now they're closing right back in the middle of it. Now, what does this mean as we look at the bond market? And you can see, look at this Treasury bond market. It's down, closed at 2.405 because my chart shuts down on the Treasury market a half hour before close. I, again, don't know why. It just does. And at the moment, we can see we're at resistance from where it was back in 2017. And if we can see, you can see in 2017, yields fell down to 2.2. And then again down to 2.15 and all the way low down to 2. So right now we're seeing that resistance down here, this dashed purple line, became support. This is still bearish for yields, saying the yields are headed lower, and that will bring stock prices down. Now, how do we know that will bring stock prices down? Well, we can do an overlay with the S&P 500 that we've done many, many times. And there you can see there is a symbiotic relationship between yields and stock prices. And right now, stock prices are saying that Treasury yields need to be, say, near this 3% range. And the yields are saying that stock prices need to be somewhere around, say, below this point. So they need to be probably below their December lows. Since the December lows for yields was here, and stock prices here, it says that stock prices need to go much, much lower. Obviously, that hasn't happened yet. The question becomes is which one is right? And the simple answer is the bond market is always more accurate. Always. Bond market is always a better predictor. Now, why do stock prices come down and retest the same level? Why don't they just bounce and go? Because people who sold down into that level want to make sure that those buyers who bought are still buyers. So that's why you see these double bottoms or double tops or triple bottoms or triple tops. It's just confirmation that, oh, those buyers down there were serious and they have more money to buy. Well, okay, fair enough. So it's just checking in to see what is going on down there. And that is why the S&P 500 is going to revisit its December lows. The only question is, will it hold it? The Treasury market right now is saying, no bueno, not going to happen. You're going lower. And if the Treasury market continues selling, which it likely will, because the yield curve has inverted, meaning, now this is really interesting, the federal funds rate is 2.5%. Let's go back to the 10-year Treasury yield. I'll zoom it in. It closed at 2.405. I know this is wrong. But anyways, what that tells us is the 10-year Treasury yields are lower than the federal funds rate, which is the overnight banking rate. That is a massive problem in this market right now. We're seeing all kinds of long-term yields fall below short-term yields. It doesn't make any sense. I mean, it does make sense. I'm writing about it on Friday, why these things happen, but it is not a good signal for the health of the economy. It says there are structural issues. It says it's going to curtail bank lending, and you should see stock prices fall, namely bank stocks. So let's take a look at the bank stocks here. We'll go look at the regional banks. We'll zoom this out, and you can see regional banks took a dump here. They crossed through this support band and tried to check in with it and were rejected. Now let's overlay the S&P 500 with the regional bank stocks. Voila. Notice they have a nice relationship. In fact, we can even go further out, and you can see they have a really strong relationship. Obviously, there's going to be points where they are not together, but what this tells us right now is the S&P 500 should be back right around 2,400. So again, you just have more and more validation that stock prices are not where they should be. The market is saying something here. It's telling investors, the bond market is telling you, hey, if you're in stocks, watch out below. There is at least a retest of December lows. And if it blows through the December lows, there's going to be an acceleration of selling. This is going to be a tremendous buying opportunity for anybody who has cash or cash equivalents, because if you get that low, break through that December low, it's going a lot farther. It's not going to stop. We're probably going to revisit the election levels of 2016 and possibly even a bit lower. And what will happen is these big investors who have just tons of money in stock will not be able to sell. They will have to short their own book to hedge their losses. When they pull those shorts off, stock prices will rally back very strongly. Again, this is exactly what we saw in the 6 months in 1930 from starting in January. Heavy stock ownership, market fell, short covering, drove market back, and then the big money sold as the retail investors came back in. So that's our update for Monday. I know that was kind of quick, but we'll be back Wednesday with some more interesting stuff on what's going on in the markets. I'm Steve Van Metre. Bye now.